Good afternoon and welcome to another edition of Facebook Live. If you missed the On the Money show yesterday, we had a pretty interesting topic. The stock market on Friday, it did hit an all-time high again. And the question is, what do you do now? What's going to happen next? If you look at what's happened with the stock market over the last 8 years, since the bottom, March the 9th of 2009, it's been quite a ride. It bottomed out March the 9th at 6,000, the Dow, at 6,507. Then it came roaring back, setting record after record, and now it's up above 20,000. So if you're invested in the stock market today, the question is, what do you do now? Is it time to get out? Time to take some chips off the table? And is it possible you're taking more risks than you even realize? On the other hand, what do you do if you're not in the market? If you've been sitting on the sidelines in cash, should you jump into the market now, or are you just too late to the party? Well, these are the questions we get every day. And I got to tell you, when you look at the metrics, markets are chasing the highest valuations in history. And as usual, they're being cheered on by the mainstream media. Barron's had a story that came out. After it hit 20,000, they said, next stop, Dow, 30,000. Barron's argued that the Dow hitting 20,000 was no fluke. They said today's stock prices are well supported by corporate earnings and economic growth. And I say malarkey when you fact check this. Where you, as Donald Trump would like to say, when you break out the fake news reports, let's fact check this. Corporate earnings have been weak for the last 2 years. In 2015, S&P 500 earnings declined year over year on both a GAAP and a non-GAAP basis. Businesses have not been doing well. The earnings are inflated by low effective corporate tax rates, low interest rates on the money borrowed to buy back stock and pay higher dividends, and sluggish wage growth. U.S. corporations are significantly more leveraged now than they were on the cusp of the financial crisis in 2007, a condition that's disguised by record low interest rates that are now rising. And when you look at Dow 20,000, it isn't really all it's cracked up to be because it's an inexact science. The composition of the Dow has changed over time. David Rosenberg pointed out that if the 8 companies that were replaced in the Dow since April of 2004 had remained in the index today, the Dow would be at 12,886, not 20,000. And also, they're price weighted. The index is price weighted, which means certain stocks are going to move the index more than others. In fact, moves in Goldman Sachs have 8 times the impact on the Dow as those of General Electric. And that's kind of what's happened since the election. Goldman Sachs took off when Trump got elected, and gee, probably not so much. Tracking the Dow makes for good financial television, but it's comparing apples and oranges and means little analytically. All Dow 20,000 accomplishes is getting investors all stirred up that they're missing the rally. Peak valuations, again, when you look at the Shiller PE ratio, it's almost as high as it's higher than it was in 2007. It's not quite as high as it was in the dot-com bubble. So, valuations are really getting stretched. And what's the reason for this? Why has the market been going up? Well, number one, the most powerful structural force at work. There's an unprecedented amount of money pursuing a diminishing number of U.S. stocks. There's roughly half as many publicly listed companies trading on the stock exchanges today than there were 20 years ago. The peak of 7,322 public stocks was reached in 1996. By late 2015, the number was down to 3,700 due to mergers and acquisitions. ETFs sprang up, private equity companies, a lot of different reasons. But the number of publicly listed companies has shrank significantly in the last 20 years. So what you have is there's much more money in the world today chasing this diminishing number of investment opportunities. While the number of stocks dropped in half over the last 20 years, the global supply of money available to invest in them exploded by the central banks. I think the biggest danger right now is higher interest rates. If the Fed continues to raise rates 3 or 4 times this year, that could certainly put a halt to this stock market bubble that we've been seeing. So again, if you're an investor out there, what are you to do today? Well, as we tell people all the time, the 3 rules that you ought to do is don't panic. Investing is as much about psychology as numbers. Selling out of fear is almost always a mistake. Diversify. You got to be diversified. And finally, rebalance. If the markets come up a lot and now you find your allocations are a little out of whack, you might want to rebalance and get them back to where you're comfortable with it. This has been another edition of Facebook Live.